Welcome back, my beautiful crypto buds. Part 2 of the Ichimoku series. If you haven't seen part 1, check the description below. I left the link there for you. And as always, these videos are for educational purposes only, so trade at your own risk. So let's get started. All right, the first thing I want to cover is the cloud itself. So I'm going to turn off everything except those two lines, which if you remember is Chikous span A and Chikous span B. So whenever A is above B, you see it gives this green fill or whatever fill you have on your chart. And when A is below B, it gives the red fill. And this is what makes Ichimoku nice, is you can see kind of where the retraces were, the uptrend, retrace, and then the uptrend. These are also used for our so-called support and resistance levels, with Chikous span A being our first level and Chikous span B being our second level. Now, if the price were to come down through Chikous span B, that would be known as the cloud break. This is a strategy that we use. You can either sell it as it goes down or you can buy it as it goes up. I'll make that a little more clear as we develop this video here. But just for now, just kind of understand the basic structure of how the cloud is made. So if we put the candles back on to demonstrate the idea of this support levels, we can go back over here and look. This bounced 1, 2, 3 times off of the Chikous span A. Support level 1, if you will, and then finally rose up. And then it did break through a small cloud break here, so it wasn't really the best cloud break. But again, if we're bullish, we're waiting for it to come back through, and you can see it bust through here, and then it just went on a tear. So if we look at some other charts to get a better idea of these cloud breaks and bounces, here's OMG's 4-hour chart. Some of it does pierce through the second support level and then bounces back up. And as you can see with the cloud, it still has stayed green. So these are all good potential rebuy areas or add-ons, whatever you're thinking. So our goal is going to be waiting for other confirmations through Ichimoku to let us know when to buy, when to sell, or at least get the idea of when to do that. Now, one last thing I want to cover with the cloud is multiple time frames. As always, you should start with a higher time frame and work your way down when you're analyzing any chart. And what that means is you want to start out with, say, the daily is a good place to start, because this is going to be your overall trend of whatever pair you're looking at. And you can see this is quite ugly for ETH versus BTC. So from here, we want to work our way down into the 4-hour to see if we can find maybe a potential breakout to the upside. And as we can see, there is a little bit of a fake break. We're going to need other confirmations to get in on this before it really decides to rip. And that's the same going for 4-hour to 1-hour. Can you catch this move? Now, if we look on the 1-hour, this looks great, right? This is coming down to support area here too, and it bounced right back up. So this could be indicative of this cloud break. And if you look over here, the cloud twist, which would indicate a clear, significant cloud break and reversal. So this chart's good to look at in terms of why we use the multiple time frame. Say you were on the 1-hour chart watching this, try to make this cloud break, and you bought in, and then it goes up and comes back down. If you're making a short-term trade here, you might not know without looking at the 4-hour where your take profit area is. But if you zoom out and you see this whole big cloud up here, so you can just even plot a line, zoom back in, and there's your take profit area. Real quick, say you did get in there, that's about 30%. So I mean, that's not a bad trade at all. So next thing we're going to cover is the TS and KS. So we're going to take off the cloud and the candlesticks again and only have those two showing. I'm actually going to take off the yellow or the blue line as well and switch my chart to Bitcoin for this example. So the TS can tell us the overall trend of the market. You see the uptrends and the downtrends, some of the sideways action. You look in here, you'll see some flatness. This flatness comes from the way the TS is calculated, taking the average of the highest high plus the lowest low of the last 20 periods. So how does this differ from any other regular moving average? If we add the 20 moving average on here, so as with the MA up here, you see there's more rounded dips and not so much flat patterns. That's because the MA is actually calculated using the closing price for the last 20 periods. So because the TK is calculating the average of those prices, that's what gives it this flattened period. And it's just saying that, you know, it's been sideways trading for the last 20 periods. And then you can see some angle changes here, which, you know, is the price moving up or the price moving down, depending on the angle. You know, if the steeper the angle, the faster the price moves. So as a trader, you know, you obviously want in right before the angle, and that's when the price is going to start to take off. So if we put the sticks back on here, you know, you'll see these real steep moves up, and then some slight sideways trading, and then a steep move up. One last thing about the TS, since it is the faster moving average of the two, we need to be careful on how much weight we actually put into it. We're going to want to use other indicators within Ichimoku to confirm, you know, a bull or bear run, trend reversal, or whatever kind of trade idea we're trying to set up. So next we're going to go over the KS, which is the same thing as the TS, but remember it's just a longer time period. So what that does is make it a little bit more reliable indicator for us to tell if there's some kind of reversal coming, if there's a bounce coming. All right, so I took off the 20 MA we had, and I put back on our KS. So the blue line is the KS. This one is a little bit more reliable because remember, this is calculated slower using the last 60 candles instead of 20. So this can be our so-called support and resistance level 1. If the price breaches any of these two, we could see it come back into the cloud, which would be our second area of support and resistance. And that's kind of the area of reversals, cloud breaks, everything that we're looking for. So I'm going to put the sticks back on here to illustrate that idea. You see as the price flattens out here, the TK also flattens out. And then we finally do get some kind of a break. And as the price moves away from the TS, it does come back and touch and continues on its way up. Now you notice this flat area. This is the equilibrium. This is when the two come together. This could signal the downtrend, some type of retrace. If we do put the cloud back on, you can see that it comes into the cloud. So this is a huge area of support and resistance. And then it just broke to continue on up. So when we use the TS and the KS together, we can use it for entries and exits. You see the big run up here? Your first stop could be the first line or the second line. And then you get out of that trade and wait for the next setup here. So a trade setup here, we would want the confirmation of the TK cross that we covered earlier. It's kind of hidden back here, but you see a TK cross with a cloud break here. So those are two good confirmations that this might continue the upwards trend. And if we were to calculate the cloud, where it would be 30 sticks in the future of this cloud break here, we see we do get a bit of a cloud twist right here, which I'll cover in the next video. But that's actually 3 good confirmations, so this would be a decent trade to get into somewhere around this area. So the TK cross, just like the cloud breaks, not all the crosses are the same. The one above the cloud is a better confirmation that our trend is going to continue upward. So that's kind of the ones we're looking for. So rule of thumb is only look for TK crosses that happen above the cloud. And this will keep you out of trouble, fake breakouts, fake cloud breakouts. So we're going to look at NEO 1-hour chart to illustrate this idea. You see here, there is a cloud, a TK cross here that happens within the cloud. This causes the price to kind of spike up, but it gets stopped out just a little bit above the cloud and then comes back in, and then it makes the initial break all the way up there. So say you did get in this trade on the first initial cloud break in the TK cross in the cloud. You'd have pretty much been stuck in this for, you know, a day, day and a half until the initial pop here. And you may have even got stopped out here as it dropped, depending on your stop loss. So just to reiterate, you know, just make sure the TK cross, for anybody new to the system, just make sure the cross happens above the cloud before you get into any kind of position, because you don't want to get whipsawed out of things like this. This did have a nice run up, and then it just plummeted down, and then another nice run up. So if we actually look at another example here, Aetherium, we're going to use the 4-hour chart. If we go back to November 13th, there was a nice little breakout here. It's almost the same thing that happened in NEO. You get the cross in the cloud, and then the breakout, and then it just snaps back down. Remember, if you look at the cloud here and the TS and KS, you can see like the flatness. So this is just the equilibrium pattern that we're waiting for it to break. So the safer side with more confirmations would be a little bit into November the 22nd, actually 11/22 here. We have a TK cross that happens above the cloud. It's a nice angle going up, and you can see this huge run up here. That's what? It's about 30% there. So again, that's not a bad day trade. This is maybe 2 days, 3 days here. So maybe you wouldn't have captured all 30%, and you get out as the candle closes below our first support line here. So I mean, these are just ideas that you want to look for, cloud breaks with the cross above the cloud. That's the main thing I want you guys to take away from the TK crosses. So the last piece of the puzzle that we need to add back on is the CS. Remember, this is the lagging line. This tells us the current closing price 30 periods back. So if we look at this cloud break here, let's go 30 sticks behind, and we see that the CS is just inside this cloud. So one confirmation that we can use this for is when the CS breaks out of the cloud. When the CS breaks out of the cloud, we consider this a cloud break as well. And this is strong because if you have a cloud break of the price and a CS cloud break, plus a TK cross and a Kumo cross, the cloud twist, these are 4 confirmations that something good is probably about to happen to the chart. So that's kind of what we're looking for here. I'm going to take off everything and just leave the CS to give a little bit of a better explanation and show you something really cool that you can do with this. So if we go ahead and take off the candles, plus everything else except that. Let's bring that over here. Can you guys guess what we can use this for as well? Think. Just like everything else we've been doing through this lesson, this is another support and resistance level. So what I want you guys to do is just look at this and plot lines on every peak. So we can put a line here, we can put a line here, all right, so we have a couple lines here to illustrate that. So once you got a few lines, go ahead and add back the candles, and boom, you have support and resistance levels here. So not all of them are exactly, weighted the same, but we can see, any kind of break of the support or resistance level causes this thing to increase. So that's another indicator. So you see in this area, the price is below the actual formation here. So that's not a good time to go ahead and buy. I think you guys can agree. So we're looking for some kind of break, and you can see that happens on 12/7 here. It actually breaks past these candles and continues upward. So what does this correspond to with our current chart here? Let's go 30 sticks into the future, and that's right about here. So right about here would have been, a decent buy. I want to move this one up a little. And then we can add another one into here. Now you could have bought at that candle and you would have got in a pretty nice rise here, or you could have waited for the CS to actually break this current line. Let me make that a different color so you can see it. You know, to break the red line. And once the CS breaks that red line, it does shoot down a bit, but then, you know, it starts to come back up. So if we go ahead and add the cloud back on and all the other essentials, we can start making, you know, a better picture of what's going on here. So look, that almost corresponded with a TK cross. You know, granted, it is below the cloud, so this isn't the best example, but you guys do get the basic idea of what the CS can do. So let's take a look, one more example. I think Bitcoin is probably a good one to look at. All right, I'm just going to take, all right, I'm just taking off everything and leaving the CS again on our chart. And then we can plot some lines the same way. Here you could just hit, you know, all the major ones. Well, you can use that, this one here. All right, and then go ahead and plug those back on and look at that. So then if we put on the cloud, whoop. And the TK, I mean, look at this bottom line here. So if we actually get an example from Bitcoin, let's go back. Got to go back a little bit in time here. So here's an example of a cloud breakout. We have the TK cross that happens inside the cloud, but as soon as it pops out, we have a nice angle on both of these. So if we go 30 sticks back, we also see that the CS has broken out. So if we just want to plot our lines, let's use the past here. This one and that one. So if we draw our lines on the CS from 913 and 915, those could be our indicators as to when to buy, I guess, or our confirmation. Whenever the CS starts to break out of this as well, we can try to get into the trade. And then you see this does come back and it just kind of stays in between the TS and the KS and just continues to flow upward. And then we have this sideways movement, the equilibrium stuff going on that we were talking about, and then another break. And then you can see the CS starts to come back and it breaks through the TS and KS. And that just causes this huge movement down. And as we zoom out, you know, you get the better picture. So I hope this wasn't too much material to take in. If you guys do have to rewatch the video, definitely do it. This is the foundation of the system that we're going to use here. The things that we need to look for to make sure that we have multiple confirmations before we get into a trade. So what I want you guys to do is just, you know, find a chart. If it's Bitcoin, Litecoin, whatever coin you want, you know, and start drawing these lines and just start paying attention to how the market moves. You know, whenever you have these cloud breakouts, you see the price is always going to come back to some kind of equilibrium, and that's our TK. You know, so never have FOMO again by using Ichimoku, because you know the price is going to come back down. It's like a magnet, sucks it back in. So use the things through this video and try to come up with an idea of what you think, you know, the price is going to do. Even if you aren't actively trading, you can paper trade. Just set up ideas and see if they pan out. I mean, that's the best way to learn anything, really. All right, so that's going to be the end of part 2. Part 3 is going to cover more of the cloud twist, and we're also going to add the awesome oscillator, which will help with some more confirmations to make sure that we're getting in the right trades. So hit like, hit subscribe, follow me on Twitter at 9ofalltrades, and I'll talk to you guys soon. Later.